Welcome to our channel, your go-to source for all things investment and business. In today's video, we're going to explore one of the most popular investment vehicles in the market today, ETFs or exchange-traded funds. Whether you're new to investing or a seasoned pro, understanding ETFs is crucial for building a diversified portfolio. By the end of this video, you'll have a thorough understanding of what ETFs are, how they work, the different types available, and the benefits and risks associated with them. But before we dive in, it's important to note that I am not a licensed financial advisor or professional investor, so always do your own research and consult with a financial advisor before making any investment decisions. Let's dive right in. An exchange-traded fund, or ETF, is a type of investment fund that holds a collection of assets such as stocks, bonds, commodities, or even a mix of various asset types. ETFs are designed to track the performance of a specific index or sector, and they can be bought and sold on a stock exchange, just like individual stocks. To give you a more concrete idea, think of an ETF as a basket that contains a variety of investments. This basket could be filled with stocks from companies in the S&P 500 index, government bonds, or even shares of international companies. The key advantage here is that by purchasing a single share of an ETF, you gain exposure to all the assets within that basket, providing instant diversification. Unlike mutual funds, which are priced at the end of the trading day, ETFs are traded throughout the day on major exchanges. This means their prices fluctuate based on market demand and supply, similar to how individual stocks are traded. ETFs operate through a unique creation and redemption process that involves large institutional investors known as authorized participants, or APs. These APs play a crucial role in ensuring that the ETF's price stays in line with the value of its underlying asset. Here's how it works. When an AP wants to create new shares of an ETF, they first buy the underlying assets that the ETF is designed to track. For example, if the ETF is tracking the S&P 500, the AP would purchase shares of all the companies included in that index. The AP then delivers these assets to the ETF issuer, who, in return, provides the AP with newly created shares of the ETF. These shares are then sold to investors on the stock exchange. The reverse happens when shares are redeemed. If an AP decides to redeem ETF shares, they return the shares to the issuer in exchange for the underlying assets. This creation and redemption process helps to keep the ETF's market price closely aligned with the net asset value, or NAV, of its underlying assets. There are several different types of ETFs available in the market, each tailored to specific investment strategies and goals. Let's go over some of the most common types you'll encounter. Passive. ETFs aim to replicate the performance of a broader index, either a diversified index like the S&P 500 or a more specific, targeted sector or trend. The main advantage of passive ETFs is their low cost, as they require less management compared to actively managed funds. By simply tracking the performance of an index, passive ETFs offer broad market exposure with lower fees, making them a popular choice for long-term investors. Unlike passive ETFs, actively managed ETFs do not target a specific index of securities. Instead, they have portfolio managers who actively select and manage the securities within the portfolio. This hands-on approach can offer higher returns, especially in volatile or niche markets, but it often comes with higher management fees. Actively managed ETFs can outperform their passive counterparts, but the success largely depends on the skill of the portfolio managers. Bond ETFs are designed to provide regular income to investors. The distribution from these ETFs depends on the performance of the underlying bonds, which may include government bonds, corporate bonds, and municipal bonds, state and local bonds. Unlike the individual bonds they contain, bond ETFs do not have a maturity date, allowing them to trade continuously on the exchange. These ETFs are popular among income-focused investors looking for steady returns with lower risk compared to equity ETFs. Stock ETFs consist of a basket of stocks that track a specific industry or sector, such as automotive, technology, or foreign markets. The goal is to provide diversified exposure to a particular industry, including both established high performers and newer companies with growth potential. Stock ETFs typically have lower fees compared to mutual funds and offer the advantage of trading flexibility, but unlike mutual funds, they do not involve direct ownership of the underlying securities. Industry or sector ETFs focus on specific segments of the economy, such as energy, technology, or healthcare. For example, an energy sector ETF might include companies involved in oil production, renewable energy, and utilities. A notable example is BlackRock's iShares US Technology ETF (IYW), which mirrors the performance of the Russell 1000 Technology Index and holds stocks of 1,374 companies in the technology sector. These ETFs allow investors to concentrate their investments in sectors they believe will outperform the broader market. Commodity ETFs invest in physical commodities like crude oil, gold, or agricultural products. These ETFs offer a way to diversify an investment portfolio, making it easier to hedge against market downturns or inflation. Holding shares in a commodity ETF is typically more cost-effective and less complex than directly purchasing and storing the physical commodity. Commodity ETFs are popular among investors looking to gain exposure to commodities without the logistical challenges of owning the physical assets. Currency ETFs track the performance of currency pairs, which may include both domestic and foreign currencies. These ETFs can be used by investors to speculate on currency prices based on geopolitical and economic developments, or to hedge against volatility in foreign exchange markets. Currency ETFs are also useful for those involved in international trade, such as importers and exporters, looking to mitigate currency risk. Bitcoin ETFs expose investors to Bitcoin's price movements within their regular brokerage accounts. The first spot Bitcoin ETF was approved by the SEC in 2024, allowing investors to purchase and hold Bitcoins as the underlying asset through ETF shares. Prior to this, Bitcoin futures ETFs, approved in 2021, allowed investors to speculate on the future price of Bitcoin using futures contracts traded on the Chicago Mercantile Exchange. Bitcoin ETFs provide a regulated and convenient way for investors to gain exposure to Bitcoin without directly owning or managing the cryptocurrency. Ethereum ETFs, or spot Ether ETFs, provide a way for investors to gain exposure to Ether, the native cryptocurrency of the Ethereum blockchain, without directly owning it. In May 2024, the SEC permitted the listing of ETFs holding Ether on NASDAQ, the Chicago Board Options Exchange, and the NYSE. By July 2024, 9 spot Ether ETFs were officially approved to begin trading on US exchanges. These ETFs offer investors a regulated and accessible way to invest in one of the most widely used cryptocurrencies. Inverse ETFs are designed to profit from declines in the price of stocks or indexes by using short-selling strategies. Shorting involves borrowing a stock, selling it with the expectation of a decline in value, and then repurchasing it at a lower price. Inverse ETFs use derivatives, such as options, to achieve these short-selling effects. However, it's important to note that inverse ETFs are often structured as exchange-traded notes, ETNs, which are unsecured debt obligations rather than true ETFs. They are typically used for short-term strategies and carry higher risks. Leveraged ETFs aim to deliver multiples of the return of an underlying index or asset. For example, a 2x leveraged ETF on the S&P 500 seeks to return twice the daily performance of the S&P 500 index. If the index rises by 1%, the ETF is designed to rise by 2%, and vice versa. These ETFs achieve their leverage through the use of debt and financial derivatives such as options and futures contracts. While leveraged ETFs can offer amplified returns, they also come with amplified risks and are generally recommended for experienced investors looking to take advantage of short-term market movements. ETFs have gained popularity for a variety of reasons. Here are some of the key advantages that make them an attractive option for investors. One of the biggest benefits of ETFs is diversification. By investing in a single ETF, you can gain exposure to a broad range of assets. For example, an ETF tracking the S&P 500 gives you access to 500 of the largest companies in the US, spreading out your risk across multiple securities. Instead of putting all your money into one or two stocks, ETFs generally have lower expense ratios compared to mutual funds, especially those that are passively managed. This is because ETFs often track an index without the need for expensive management teams, which can lead to lower fees for investors. Over time, these lower costs can have a significant impact on your overall returns. ETFs trade like stocks, meaning you can buy and sell them throughout the trading day at market prices. This gives you the flexibility to respond to market changes in real time, unlike mutual funds, which are only priced at the end of the trading day. The high liquidity of most ETFs also means that you can enter or exit positions with minimal impact on the price. ETFs are often more tax efficient than mutual funds. This is largely due to the way ETFs are structured. The creation and redemption process helps to minimize capital gains distributions, which can save you money on taxes. In contrast, mutual funds often distribute capital gains to shareholders, which can create unexpected tax liabilities. Most ETFs disclose their holdings daily, so you always know exactly what assets the fund is invested in. This level of transparency is a big advantage, especially when compared to mutual funds, which typically only disclose their holdings quarterly. Knowing what you're invested in helps you make more informed decisions about your portfolio. While ETFs offer many advantages, it's important to be aware of the risks associated with them. Here are some of the key risks you should consider before investing in ETFs. Like any investment in the stock market, ETFs are subject to market risk. If the value of the assets in the ETF declines, the value of the ETF will also decline. This is true for all types of ETFs, whether they track a broad index, a sector, or an individual commodity. Tracking error is the difference between the performance of the ETF and the performance of the underlying index or assets it's supposed to track. This can occur due to fees, expenses, or imperfect replication of the index. While tracking error is usually small, it's something investors should be aware of, especially with less liquid or complex ETFs. While many ETFs are highly liquid, not all of them are. If an ETF has low trading volume, it may be difficult to buy or sell shares quickly without affecting the price. This is especially a concern for ETFs that track niche markets or sectors. Before investing, it's important to check the trading volume and liquidity of the ETF. ETFs that focus on a specific sector or industry can be more volatile than broad-based ETFs. For example, a technology ETF might experience significant price swings if the tech sector goes through a period of instability. This concentration risk means that while you might see higher returns in a booming sector, you could also face greater losses if that sector underperforms. Leveraged and inverse ETFs are designed to deliver amplified returns based on the performance of an underlying index. However, these ETFs are complex and can be risky. They are generally intended for short-term trading rather than long-term investing. The daily resetting of leveraged ETFs can lead to compounding effects that might not align with the long-term performance of the underlying index. With so many ETFs available, how do you choose the right one for your portfolio? Here are some factors to consider when selecting an ETF. First, consider your investment objectives. Are you looking for long-term growth, income, or short-term gains? Your investment goal will help you narrow down the type of ETF that fits your strategy, whether it's a broad market ETF for growth, a bond ETF for income, or a sector-specific ETF for targeting a particular industry. The expense ratio is a key factor because it directly impacts your returns. Lower expense ratios mean you keep more of your investment gains. Passively managed ETFs generally have lower fees than actively managed ones, but it's important to weigh the potential benefits of active management against the higher costs. Liquidity is important, especially if you need to buy or sell quickly. ETFs with higher trading volumes tend to have tighter bid-ask spreads, meaning you'll pay less in transaction costs. Before investing, check the ETF's average daily trading volume to ensure it's liquid enough for your needs. Tracking error is the difference between the ETF's performance and the performance of the underlying index. Ideally, you want an ETF with minimal tracking error to ensure it closely mirrors the index it tracks. This is particularly important for index-based ETFs. Review the underlying assets of the ETF to ensure they align with your investment strategy. Look at the top holdings, sector allocations, and geographic exposure. Understanding what's inside the ETF will help you make more informed decisions. Consider the reputation and reliability of the ETF issuer. Well-established issuers with a strong track record are generally a safer bet. Look for issuers that provide transparency and have a history of managing ETFs effectively. ETFs are a powerful tool for building a diversified investment portfolio offering a wide range of benefits from cost efficiency to liquidity and transparency. However, like any investment, they come with risks, so it's important to do your research and choose ETFs that align with your investment goals. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more in-depth content on investing and financial planning. And if you have any questions or topics you'd like us to cover, feel free to leave a comment below. Thanks for watching.